The Minority Market. Episode 68, Understanding Moat, What Makes a Business Worth Owning. Most people enter the stock market by watching price movement. They look for stocks that are rising fast, trending on social media, or discussed in news channels. The minority thinks very differently. They do not start with price. They start with business strength. They ask a deeper question. Why does this company deserve to exist for the next 10 or 20 years? The answer to this question is hidden inside a powerful concept called the economic moat. A moat is not a technical indicator. It is not a quarterly profit number. It is the protective advantage that allows a business to defend itself from competitors. Just like a castle protected by water on all sides, a business protected by a moat becomes difficult to attack. Competitors may try to enter the market, but they struggle to take customers, margins, or market share. This protection is what creates long-term wealth. The first form of moat is brand power. Strong brands do not compete only on price. They compete on trust, emotion, and identity. Customers return repeatedly because they associate the brand with reliability and quality. This loyalty gives companies pricing power. They can charge more without losing customers. Over time, this pricing power protects profit margins and stabilizes cash flow. Another powerful moat is network effect. Some businesses become stronger as more people use them. Payment systems, platforms, marketplaces, and communication tools grow in value with scale. When millions of users already exist on one platform, new competitors struggle to convince people to switch. This natural dominance creates long-term protection without aggressive marketing. Cost advantage is another important moat. Companies that can produce cheaper than competitors gain strategic flexibility. They can lower prices to gain market share or maintain higher margins while selling at normal prices. This advantage often comes from scale, logistics efficiency, supplier relationships, or superior manufacturing processes. Over time, low-cost leaders slowly push weaker competitors out of the market. Switching costs create invisible barriers. When customers invest time, money, and effort into using a product or service, they hesitate to change. Software platforms, financial services, and enterprise tools benefit heavily from this. Once systems are integrated into daily operations, customers remain loyal even if alternatives exist. This stability protects long-term revenue. Regulatory protection and legal advantages also create moats. Government licenses, patents, exclusive contracts, and regulatory approvals limit competition. Pharmaceutical companies with strong patents enjoy protected revenue periods. Infrastructure businesses often operate under regulated monopolies. These protections reduce competitive pressure and improve business stability. However, the minority understands that moats are not permanent. Technology evolves. Consumer behavior changes. Regulations shift. A strong moat today can weaken tomorrow. That is why intelligent investors constantly monitor business health instead of blindly holding forever. Long-term ownership requires long-term observation. Another common mistake beginners make is confusing popularity with strength. A trending company on social media may attract attention, but attention does not equal durability. Viral growth without protection attracts competitors quickly. Without moat support, profit margins collapse and growth slows. Sustainable advantage always matters more than hype. Moats also protect downside risk. During market crashes or economic slowdowns, strong businesses recover faster. Customers return. Demand stabilizes. Weak companies struggle to survive. The minority prioritizes survival before profit. Protecting capital starts with owning businesses that can endure stress. Understanding moats changes your mindset completely. Instead of asking, will this stock double next year? You start asking, can this business dominate its industry over decades? This long-term thinking improves patience and emotional stability. Short-term volatility becomes noise instead of panic triggers. You do not need advanced financial modeling to identify moats. Observe customer loyalty. Study competitive behavior. Understand industry structure. Look at how companies perform during crises. These real-world signals often reveal strength more clearly than numbers alone. Moat thinking also improves portfolio quality. When you own strong businesses, you reduce the need for frequent trading. You allow compounding to work quietly. Time becomes your ally instead of your enemy. The minority understands that wealth is built through ownership of durable systems, not through chasing fast money. Businesses with strong moats generate cash, reinvest intelligently, and grow steadily. This compounding effect creates long-term advantage. Remember, the market rewards patience and quality. It punishes speculation and impatience. When you train yourself to identify strong moats, you stop behaving like a gambler and start thinking like an owner. This is the difference between trading price movement and building real wealth. This is the mindset shift that separates majority behavior from minority discipline. In the next episode, we will go deeper into capital allocation and how intelligent distribution of resources shapes long-term performance and stability.